comparing bonds, the contract rate versus the market rate. Remember in the previous video, I had told you about the contract rate. That is the stated rate on the face of the bond itself. But that is not necessarily the only rate that comes into play when an investor is looking to purchase a bond. So the contract rate is how much interest that the bond will pay, those periodic payments. That's part of the bond indenture. The contract rate is what is used to calculate that interest. The market rate, however, fluctuates based on the supply and demand, what people in the market are willing to pay for any product, not just a bond. But the market rate fluctuates based on what else is in the market. So the market rate itself is determined by investors. It basically shows what an investor would be willing to pay for another similar instrument. It is used to calculate the price of the bond. And so that's a little different, a little extra added information that I didn't talk about in the previous video when I was just giving you the basics. So we talked about in the previous video that a bond would sell at its face value. The corporation would make periodic interest payments to the bondholder with a final repayment at the end of the term for the bond's face value. Now that we're also incorporating the market rate, what we'll see is that the market rate determines what the price of a bond actually is. So even though the bond on the face value or the face of the bond and within the contract, for example, even though that says that it is a $1,000 bond with 10% interest, that does not necessarily mean that that is what the investor will pay for that bond. So if an investor is looking to invest, they obviously will kind of shop around to see which product would be most valuable to them. So if an investor is looking at one particular business and the bonds that they are issuing, they want to check to see, is that a valuable interest rate to them based on the bonds that are being issued by other companies in the market right now? So they'll shop around. So this example is showing a business's bond. So you can see it's a $1,000 bond, face value is $1,000, and then the interest rate that goes along with that bond is 6%. That is called the contract rate. That is what is in the bond's contract, that it will pay 6% interest, period. What can differ slightly is the amount that a bond holder or an investor is willing to pay up front. Now they'll only get repaid at the end, the maturity date, they'll only get repaid the face amount. But we will look at some scenarios that might change what an investor is willing to pay upfront for a bond. But you can see here that other similar bonds in the market are also paying 6%. So here, the contract rate and the market rate are equal. So this is when we say that a bond is selling at face value or selling at par. So if an investor is choosing between multiple bond issuances in the market, seeing what bonds are out there, and they see that typically the bonds that they're looking at all have a very similar interest rate, in this case 6%, then it doesn't necessarily matter which bonds are purchased. It's going to be very similar or exactly the same. So this is our easy example when everything matches and it's beautiful. But things can get a little more confusing. So this is just showing an illustration of what we just went over. So the $1,000 face value and the 6% contract rate. So the business is looking to issue bonds. That means that an investor is looking to invest. They see this $1,000 bond. Face value is $1,000. Interest rate is 6%. So they are willing to pay $1,000 for this bond. So that's exactly what they do. So they pay $1,000 to the corporation at the bond issuance. The corporation has a stated rate of 6%, which means that those periodic interest payments will be 6% of $1,000 annually, which is $60 per year. So the corporation, year one, pays $60 interest to the bondholder, the same in years 2, 3, 4, 5. Then at the end of year 5, in addition to that $60 interest payment, they also have to repay the face value or the principal. So then that $1,000 is repaid back to the bondholder. Those calculations are very simple. If an investor is shopping around, looking at different bonds, obviously they are looking for the bonds that are most valuable to them, typically the ones that will pay the most interest over time, because they're going to be making an investment either way. What they're looking for is a greater return on their investment. So for example, if a company is issuing $1,000 bonds with a contract rate of 5%, that means that they will pay out 5% annually over the life of the bond. But if other bonds in the market, similar face values, are paying at a greater interest rate, then obviously it's a no-brainer for someone to choose a bond that's going to pay them more over time. So most rational investors would choose this bond. What that means for the business is that not as many investors will be looking to invest with them with this bond issuance. So just like any product that's on the market, if you're having trouble selling your product, typically what you can do is figure out an incentive for someone to buy your product. So you would offer a discount. And so that's what companies do as well when their contract rate is less than the market rate. They have to offer a discount. So what that means is that instead of paying $1,000 for this, they would, for instance, allow just a $900 initial investment. So we'll talk about that more in just a little bit. So here's an illustration of what I just discussed. So if someone decides to purchase the 5% bond, then they could do that at a discount, for instance, of $900. So to calculate the interest payments though, you still take the face value times the contract rate. So the amount of interest that is paid, that does not have to do with what the bond actually sold for, because that's based on the market. When you're looking at interest, you're using the contract information. So the face value times the contract rate. So what's different this time is that the investor is only paying $900 or only lending $900 to the company. But the company is still paying the same amount of interest as if someone purchased the $1,000 bond at 5% interest instead of receiving a discount. So year one of interest is $50 calculated here. Year 2, 3, 4, 5. Then when it comes to repayment, the full face value is repaid. So even though the bond was issued at a discount to incentivize bondholders or investors to purchase this bond, it doesn't matter what they initially paid. It will be the face value that is always repaid at maturity. So here's another situation, another scenario where we're comparing the contract rate and the market rate. So for this example, we'll say that the business is issuing $1,000 bonds. Their contract rate is 7%. But out in the market, other similar corporations who are issuing $1,000 bonds, they're only offering 5% interest. So a rational investor would choose the investment that would be most valuable to them, which is the one that would provide 7% interest annually versus the 5% that other corporations are offering. So looking at the two alternatives, investors would be more likely to choose this option for the 7% annually. So that's not a discount because we're not reducing anything to incentivize. The company, what they're seeing is rational investors are going to purchase their bond anyway because they're offering a greater interest rate. So why sell something at face value for $1,000 when there are investors willing to pay more for that just to be able to get that 7% interest rate? So that is called a premium. So a premium is when a bond sells for a greater amount. For example, $1,100. So, oops, I did that wrong. Hold on. So $1,100 instead of the $1,000. This is the example of what it looks like in terms of purchase price, interest payments, and the repayment of the face value with a bond that is sold as a premium. Remember, if it's sold at a premium, that means that it is sold for a higher price than the face value. What does not change, regardless of the price of the bond, what is actually paid for the bond, is how interest is calculated. So interest is always calculated based on the face value, even if it doesn't sell for that, times the contract rate. The contract rate is 7%. So the annual interest payments will be paid as $70 regardless of what the bond is sold for. So instead of paying $1,000, the bondholder is paying $1,100. The reason that they're willing to do that is because they will get paid more interest over time than when compared to, for instance, the other bonds that were paying a lower interest rate. So that's why they're willing to pay a little bit more for the issuance. So then over years 1, 2, 3, 4, 5, the corporation pays the $70 interest to the bondholder. Then finally, at the end of the bond's term, the face value is repaid. So remember, it will always be the face value that's repaid, regardless of what the bond is purchased for. So even though it was purchased for greater than face value here, what the business will repay at the end of the term is only face value, regardless of what it sells for. One more thing to note is that when you are quoting a bond price or when you are explaining what the bond is selling for, that's quoted as a percentage of the face value. So obviously, if it's sold at face value, then it will be sold at 100. That's how that is said. If it is selling, if it's quoted at 98, that's basically 98%. So you see that calculation here. So that bond would sell for $980. If a similar bond was quoted at 109, that is greater than 100%. So that's going to be selling at a premium. So $1,000 times 1.09 will give you $1,090.